Happy Thursday, ladies and gentlemen, Allincrypto here, and today we are going to talk about 7.4, nearly $7.5 trillion of liquidity that are potentially going to enter the risk markets as a hunt for yield begins on the back end of a lowering of interest rates. Now, those of you that follow me regularly will know that we believe that the S&P 500 is now in a new bull market, having had its bear market being earlier this year, where we saw a 21% pullback on the back end of the Trump tariff announcement. And we believe that's technically a bear market. That's certainly how a bear market is defined in traditional markets. A 20+% pullback is defined as a bear market. I think there'll at least be a little bit more nuance with that personally in regards to the world that we're now in. That certainly made sense when markets were smaller today and less volatile today. That may not be the case. However, that is still the technical definition of a recession, a bear market. And I agree with Mike Wilson and his view that actually, having had that, we've got a new bull on our hands. And if you look historically, going all the way back to 1980, every time we've had a 20+% pullback, after engulfing that and going on and putting a new high, you've actually rallied for the shortest period being 395 days. Now, if we're to follow that again today, that's going to take us into the middle of next year, which is going to throw the Bitcoin cycle out with the bathwater. And this is one reason we believe we are going to get a bit of an extended cycle. I don't even think that we've seen an alt season yet. I think that's largely been delayed, and I think you can get that looking at metrics like BTC DOM. You can get that by looking at the likes of ETH BTC and some of your other barometers, whether that's others versus BTC, whatever it may be. I still think that is all to come. And I think the reason that we need to look at this and pay attention is because we need a good macro backdrop, as crypto is a beta for the markets, meaning it overperforms them to both the up and the downside, for crypto to do well and actually flourish. And I believe we are going to get that based on certainly technically what's been the playbook for the S&P 500 following a 20% plus pullback. I also have other barometers such as the IWM versus the S&P. Now, if you're going to get a bull market, actually you're going to see small caps overperform large caps. Yesterday, unfortunately, troops, the broader markets were pulling back. You saw big pullback in gold and silver, and of course that's going to weigh on the crypto space as a beta of markets. In fact, gold was essentially a beta of crypto, having some of the worst days that it's had in a long time, single days. So we were going to relate all of this to what the main topic of this daily market update is going to be about. And I've long spoken, and it's getting more recognition. I've seen it kind of become popularized. I'm going to look at a good take on this on X. I've long spoken about how there's $7.48 trillion in money market funds, and the reason for this is very obvious. It's because they're collecting a 5 probably +% yield on just having their money sat predominantly in money market funds made up of short dated treasuries. And as interest rates come down, this is going to lower certainly the shorter end of the borrowing, so the shorter end of the debt curve, which is going to, I believe, push a hunt for yield further afield. Unintentional rhyme there. And that means that this $7.5 trillion, $7.48 trillion, a few trillion of it are certainly going to reallocate. Not all of it. There's a lot of this that's probably sat in corporates that need to have cash on their balance sheets. They're probably going to do that via money market funds as a preferred method, or a kind of valid cash alternative that actually generates a yield. It was interesting. Just a side note, we know that the Fed's been speaking, and this just goes to show you how they want to keep you guys from at least hedging the great game, which is the monetary system. Who was it? Was it Henry Ford that said, if it's a good job my workers don't understand how the monetary system works, go and look this up, or there'd be a revolution in the morning. And I think one thing that we can all be very thankful for Bitcoin as a result of Bitcoin is the fact that it's really awoken people. Certainly myself, I started off very much as a libertarian Bitcoin maxi. It's certainly awakened even myself to the monetary systems and just how corrupt and foul there are. And actually, if you can understand those, they say knowledge is power, you can actually arbitrage them and use them against you. You can put sand on your hands when you're climbing up that grease pole that everyone's on in regards to the monetary systems. If your wage isn't increasing with inflation, you are getting poorer and poorer, I'm afraid. Anyway, back to the topic at hand. There's $7.4 trillion in here. When interest rates comes down, which I believe they are going to, I'm going to show you why that is based on the 2-year yields, obviously the correlation with the Fed funds, and we'll look at the Fed watch list. This is going to reallocate, and I think this is going to be a driver of this new bull market that I believe we're in for the S&P 500 that crypto, of course, is going to benefit from at a time when crypto is on the cusp of, if you look at the total sort of, we'll do all this. We'll address all this when we come to it. We don't need to get onto it now. If you look at the total 2, it's on the cusp of breaking out. The Russell has a similar pattern. Crypto we think is going to 302K, 306K. So on and so forth. We think altcoins are really yet to start their phase 2. The stars align, and this is why when we get the kind of volatility that we do in the cryptocurrency space, we really remain unfazed because we have a plan. You want to be part of a community to help you kind of deal with this market. Now's a great time. We're actually growing pretty well despite everything taking place and the lackluster time. So money market funds. This is a take. Now, I'm unfamiliar with this individual, Shanaka Ansel Pereira. But I think he actually provides a good take here. And it very much mirrors a lot of what I've been saying for a long, long time now. The 7.4 trillion detonator, America's hidden liquidity bomb, about to obliterate every market assumption. The most dangerous number in financial history is hiding in plain sight. 7.4 trillion parked in money market funds, not in stocks, not in real estate, not in gold, not in Bitcoin, in idle treasury bills earning 5% plus, awaiting for a single Federal Reserve decision to unleash the largest capital reallocation event in human civilization. And this is true. For the large part, this money has to go somewhere, and if interest rates drop like we think they are going to, it's probably a good chunk of it, and he'll explain this a little bit more, is actually going to look to reallocate. I thought this was a really good piece that I saw last night. He goes on to say, this isn't cautious investing. This is civilization coiled spring with a central bank trigger. The detonation physics. When the Fed cuts 150 to 200 basis points, which we'll look at in just a second, money market fund income collapses by 100 to 140 billion annually. That lost yield must hunt returns somewhere else. And of course, right now, if you're in money market funds, you're effectively getting the same as what you would be with the S&P. Its average return is between sort of 6 to maybe 9%. Probably 6 is more likely. And you're kind of getting that just having your money sat in cash, short-dated treasuries for the most part. Each 1% money market fund reallocation equals $74 billion. That's the maths right now, $74.8 billion. 10% rotation unleashes $740 billion. Exceeding most national GDPs. 20% exodus deploys 1.4 trillion into risk markets. Is it going to go to risk markets? It's likely that a chunk of it certainly will. The flows don't trickle, they cascade through institutional pipes like a breaking dam. The historic pattern nobody remembers. 1998, 1.3 in money market funds. Fed cuts rates, tech bubble ignites. 2003, 2.1 trillion in money market fund. Fed cut rates, housing mania begins. 2009, 3.8 in money market funds. Fed cut rates, everything rallies 300%. 2025, 7.4 trillion in money market funds. Fed signaling cuts, unknown territory. So I don't know the 100% math on this. Some of this is a little bit skewed. It's not quite as simple as that. But I do know that there is going to be a kind of pouring out of this to the tune of, I would say, a good couple of trillion. And that's likely going to enter the markets. He goes on to say double the 2009 powder keg. But now Bitcoin exists as a 24/7 institutional grade scarcity with ETF rails. The 4 horseman triggers. 3-month T-bills drop below 4% from 4.8. Fed confirms sequential cuts beyond 1 and done. High yield spreads compress below 350 basis points, so 3.5%. Crypto ETFs inflows sustain above $2 billion weekly. Not sure about that. all four converging detonation sequence. The Bitcoin mathematics money market fund pile 7.4 trillion at 5% yield. Bitcoin supply 21 million. Fixed 96% mined. BlackRock IBIT 100%, $100 billion AUM in under 10 months. Fastest growing ETF ever. Certainly to get to $10 billion. I think it took 50 2 days, something like that, something along those lines. Ethereum took substantially longer. If 5% rotates, which is 370 billion, Bitcoin goes to 280 to 350. I'm not sure about these numbers, by the way, at all. I would query these big time. If 10% rotates, so 750 billion, Bitcoin goes to 550 to 700,000. If 15% with sovereigns buying, Bitcoin goes to 1 million. Yeah, not 100% sure about this. There's a lot of factors not calculated in here, but the overall arc of this is, I think pretty good in terms of actually, look, there's a lot of money that's sat in money market funds that's ultimately going to look to come out of them, I think, as interest rates come down. The mechanics, money market funds flow through institutional architecture, prime brokers rebalancing, pension reallocation, triggers hitting, corporate treasury deployment, sovereign wealth hunting, uncorrelated returns, ETFs absorption without selling pressure, every pipe terminates at scarcity, only one asset provably finite, instantly settleable, globally accessible 24/7 Bitcoin. The Fed's choice, keeping rates high, recession debt spiral, cut aggressively 7.4 trillion tsunami, bond markets price 150 to 200 basis point cuts through 2026. I'm not sure about that either. The choice is made, the spring release, the countdown when 3-month yield crater from 5 to 3%. And this is where the majority of money market funds are sat in short-dated debt instruments, essentially. Capital doesn't deliberate. It hunts yield with systemic urgency, gold, supply, uncertain, so on and so forth. So you can tell this individual is a fan of Bitcoin, of course. But this is very obvious that there's this huge pool of liquidity or capital that may want to look to reallocate and interest rates coming down. Interest rates are coming down. I think the 2-year yield has topped. This is a longer dated treasury than he's talking about. The reason I use the 2-year US Treasury yield is because it's very correlated with this is the Fed funds. And if this is coming down to where we've got this as a target is 2.3, that is a kind of, a cut that would see what the individual is talking about take place. Also, we know in the next 6 days, the Fed is essentially set to cut interest rates again, only by a small margin, but it's all progress towards this direction and this sort of liquidity bomb unraveling. And of course, you guys know what I believe in regards to the S&P 500. I think it's a new bull market. I think it's going to be a major catalyst. And of course, crypto as a beta of that, I think is going to perform extremely well. And technically, we've got all the merit in the world to be bullish on Bitcoin. Fundamentally, we do. And certainly the crypto space at large. It's annoying. Yesterday, the Fed literally came out, or we covered it yesterday, and said, look, we're going to integrate crypto into our financial system. It's increasingly becoming interwoven in it. Meanwhile, retail a couple of weeks ago got liquidated to the tune of $20 billion. Total wipeout. And this is why you should be an investor, not a leverage trader. Those ding-dongs don't make money. They can't prove that they do. So you should, not try and pursue something that they can't even manage themselves. And I'm not saying that some people don't, but it's a very small number. Certainly, I don't think the people on YouTube advertising it do. I'll just ask for a P&L, and I'll be amazed if you get one. Quick look at total market cap. This is on the cusp of breaking out into price discovery and going to $6.3 trillion. And I think ultimately the catalyst for this, that doesn't mean $6.3 trillion needs to go into this like money market funds. That really just means that, the price of crypto needs to go up, and then it's times by supply. There's never really going to be $6.3 trillion in there, if that makes sense, which might not make sense to some. And I do think BTC DOM is on its way down. I still think that. I think BTC DOM has topped, in my opinion, and I think this was a capitulatory event again. And ultimately, you've got phase 4 ahead of you. We shall see if we're right on that in time. Also, interesting news. CoinShares has officially filed for the ProShares CoinDesk crypto ETF to be listed on the New York Stock Exchange. The fund will track CoinDesk Crypto's top 10 index, giving investors exposure to 20 cryptos. HBAR, quite a few in this. This is the sort of spread. Bitcoin, Ethereum, XRP, Solana, Cardano, Chainlink, Sui, Avalanche, Stellar, Hedera, Bitcoin Cash, Litecoin, Uniswap, Aptos, Near, Internet Computer, Polkadot, Aave, Polygon ecosystem token, and Filecoin. There are 155 ETFs awaiting approval. We're likely going to get those when the government reopens. Ladies and gentlemen, that's it from me. I just wanted to highlight a potential catalyst to spur on this new bull market that we believe we're in for the stock market. And certainly crypto is really going to be fueled by that kind of a macro environment and that liquidity, in my opinion. That's it from me, guys. I'm going to love and leave you all. Thanks for watching, everyone, and I'll see you all in the next one.